What it is, Brad Lee back again with another episode of Dropping Bombs. Today in the studio, folks, as always, I got a real treat for you. I even got two of them, Cody Davis and Christian Osgood, who may or may not speak. We're going to see.
I'll speak. I'm in now.
There you go.
Thanks for having us. Good
Dude,
to see you.
Appreciate you coming out. Now, the reason why I wanted Cody on this show was because, again, as you might know, I drop bombs for people, meaning we talk about things that hopefully will avoid pain and suffering or challenges from people listening, right? So something you did or we talk about might end up saving them headache or brain damage.
Absolutely.
So that's what the concept is. And what I liked about you is you said you started with $3,000 and a goal to help your mom and turned that into having a portfolio of 105 multifamily units.
Yeah. Today
More now, I bet.
Yeah, we're a little bit over that now.
Where are you at now?
We're at 122.
Yeah, so 122. How old are you now?
23.
So you're only 23 years old and you own 122 doors?
Yeah.
And they're paying rent on every one of those doors?
Absolutely. We just did a round of renovations, about 30 apartments.
Are you afraid of the current state of affairs?
No. I think that people are always going to need a place to live, and we provide better housing.
They might need a place to live, but they may not have the money to pay you for it.
Absolutely. And so we keep housing below $1,000.
I know, but you realize, like, if the shit hits the fan, like they're saying that it's about to.
Oh, it will.
Money's going to collapse.
Absolutely.
And when money collapses, ain't no one paying your fucking rent, bro.
Yep.
So now you ain't got no money, no cash flow. And the bank's probably looking at you saying, I'm going to accelerate that loan. I need my money back. And then you can't pay them. Then what do? They snatch it. And now you're freaking out all that property, all that cash. We got guns and ammo and anarchy.
Got to play the game where the goalposts are, though.
But what are you going to do then?
Well, look, if the goalposts shift, then we'll adjust. We'll play a different game. But right now, I'm playing the game where it's at.
Good answer, young man. See, that's a pretty good answer. You got a good head on your shoulders. How about your parents? Did they, raise you well?
I mean, I think so. I love my parents. They split when I was 8, so back in 08.
If they're if they taught you this type of stuff that you're preaching now, but
not the real estate or business stuff. My dad works at Weyerhaeuser, but when I was a kid,
dude, my dad worked at Weyerhaeuser. That's crazy.
Similarities there.
Yeah,
it's
but
fun.
Weyerhaeuser, nobody knows that word.
No,
even though it's a big operation.
No one knows how to spell it either.
I do.
Oh, there you go. But when
Weyerhaeuser.
Wow,
it's Weyerhaeuser if you're sounding it out.
There you go. Yeah, I probably couldn't spell it on the spot.
Well, that's probably because you're from the Northwest as well. Seattle?
Yeah, just south in Tacoma.
Born and raised?
Yep.
Okay. So good. You graduate high school?
Graduated high school.
You went to college?
For 2 quarters.
Didn't need it.
Well,
because at 19 you found this, and then when you were in college, you're thinking, shit, I don't need to go to college anymore.
I was promised. There was this guy on Facebook. He messaged me. He was my mentor for a little while, and he said, you know what, you'll make a bunch more money if you just work for me. And 6 months into it, I made no money. So that was at a real estate brokerage. Thought I was going to do well, and I've got no family or friends in real estate, so I didn't do very well. Didn't know how to
selling
sell.
Homes?
Yeah, I didn't know how to sell, didn't know how to talk to people. I was super introverted, didn't know how to communicate. So that didn't go well as a salesman. Yeah. And had to learn over time.
Well, there's a lot of realtors out there right now that are in the same position.
Oh, absolutely.
They're sucking ass. They don't know how to sell. They don't know how to close. They don't know how to build relationships, and they're just wasting their time.
Yeah, they don't have the right guidance, the right information.
Not to mention the market's in the shitter right now, is it not?
I mean, it's a little tough, but there's an opportunity with every difficulty.
That's a fact. That is a fact. That's what I tell people. When the shit hits the fan, if this whole thing happens, which I hope it doesn't, but if this whole thing happens with money crashing and the banks crashing and all that, there's going to be opportunity everywhere.
Absolutely. And people
right along with the anarchy.
Yeah, time shall tell. But the people with the assets, regardless of what the currency does, I mean, they're going to do better than those who don't have it.
Well, you would think, but again, like, what if you have those assets and you're leasing them to people that are not paying you? And
we've been through that.
What do you do?
Well, that's the thing. We have 2 pieces for real estate. You got to figure out how do you buy, how do you never lose it. People can figure out how to buy a bunch of stuff. They can do creative debt structures or get private equity, but they don't solve for the second piece of long-term fixed rate debt, cash flow, and margin. And so we could have a 40% hit to the portfolio. 40 people, 50 people could not pay, and we would not lose it. And that's really important. Most people can't say that.
Because half of it is paying the debt.
Absolutely.
The other half's profit.
Yeah, and that's just about math at that point, but people are doing bad math. Numbers don't lie, but people do.
Well, and the good news is no matter what the condition of the market is today, give it 10 years. It'll correct itself. It always has. It always will.
Yeah, I think it will. I haven't been around long enough to prove that for myself, but
You watch, it will. Dude, your shit might have went down in value since you bought it if you've only been doing it a couple of years. But you wait long enough, that will go back up in value no matter what. Like it's a historical fact, I believe. People can look this up to see if I'm wrong. But property values have increased steadily forever.
Absolutely.
Forever. Like there's never been a time where it's like, yeah, but it went down and stayed down.
And can confirm over the long run, properties will go up in value.
So that's why I'm like, when anyone's like, well, should I do real estate? Yes. What about these markets? Don't worry about the markets. You're not supposed to be, we're not day trading homes.
Yeah, can't press a button.
Okay. You get rich by keeping them, not by selling them.
Yeah,
FYI. You get rich by keeping them, not by selling them. I had a real rich guy tell me one time, he said, dude, buying them's easy. It's keeping them. So you don't teach people, or do you?
We do.
You're saying how to buy them and keep them.
Yep.
Well, how do you keep them once you buy them?
How do you buy it is you figure out your deal, which is first. Then you figure out your debt. There's two types of money, debt and equity. And so you have to figure out the debt piece first because it's the biggest portion. Then you have to figure out the equity last. But
let's say you made a creative deal with the owner and you're good to go. Okay, now I own the building.
Fantastic.
How do I keep it now?
Well, that's a function of the debt product. Because the debt is your biggest expense typically. That's going to determine, like, is it variable, is it fixed? Is it long-term, short-term? Because a lot of people went into these deals.
What should it be?
Well, it should be long-term. And a lot of people went into deals where they're getting 2-3% variable debt on a 3 or 5 year deal. And that's come up. And now they're done because their rate went to 8. If you can't fix your variables, you're not going to be in the game very long. And so most people go in, they try and save on fees. And the problem with fees is it's a percentage of the overall income. And so you shouldn't save the fees. You should protect your assets, protect your ass, and fix the variables as long as you can. Even if it costs
how do you do that if you made a bad deal?
Well, if you made a bad deal, then you're going to have to restructure. You can refinance, you can write a check, or you can restructure. Those are the options. And so if you did a bad deal, how do you get new debt? It's probably going to be private.
Do you think if you went broke right now, both of you guys went broke right now, you got dropped off in Las Vegas, Nevada with $3,000, that you could go out and replicate exactly what you did?
Without a doubt.
How long would it take you?
Less than a year.
So we wouldn't have to spend the $3,000.
So in less than a year, right now, you guys could go into Las Vegas with no money.
That'd be a fun show.
And within 1 year, own over 100 doors.
Without a doubt. And
producing cash flow.
Yeah.
That you can now spend, obviously. That's the only money you're ever allowed to get is the cash flow.
Yep.
Can't take any money in equity. Can't go you can get debt against the equity if you can find it.
If you qualify, but if we're doing it for a year, we're probably not getting cash out because lenders aren't going to do that right now.
Okay, but you could do it.
Well, you could do it privately.
No, I mean, you guys could do that.
Without a doubt.
No doubt at all.
We did that in Grant County. We did that in Union. We've done it in King County.
We've done it on B-class buildings, C-class buildings. We've done it on A. We did it on a resort.
Don't you find that sometimes these owners look at you like, dude, you're a couple of kids?
Every time, especially Cody.
Yeah, I mean, it happens. But
and you just close them on.
I'm gonna play with it. Like I'm gonna go with it.
But are you still doing creative? Because now you got more than $3,000, don't you?
Oh yeah.
So if you wanted to, you could come up with more. So are you buying bigger, better properties because of that, or can you continue to find these deals like you found then?
We bought a bunch of assets. We have a 4-stage business cycle. You build the portfolio, stabilize it, which we've done. You optimize it, which is where you get highest and best use.
That's by going and making it nicer.
Mm-hmm. And that's what we're doing right now. And as soon as that's done, we get the maximum yield from these assets. We pay them off. That's where we're different from everyone else. We're going to pay off all the debt. It'll be all paid off in the next 5 years.
Why would you do that though?
Because we can. Nobody's
who
doing
cares?
it. Story's worth more than the real estate.
I know, but who cares? Like you'd rather own a house free and clear than owe money on it?
Yeah.
Depends on the interest.
I mean, it's not going to be a house. It doesn't depend on the interest rate for me.
Why not?
Get it paid off.
What for?
Don't have to play the game twice.
Why is it a game?
Well, I mean, real estate's a game.
I know, but listen, follow my logic, because you might be right, I might be wrong. But if I have a building over here, and let's say that building's worth $25 million,
Sure.
and I don't owe anything on the building, so I have $25 million in the building.
Yep.
Now I don't have that building because I don't have $25 million to put down on it.
Sure.
But if I just borrowed $25 million against that building, well, now I could have that building and that building, and I owe I own $25 million on two buildings.
You'll scale faster.
Right. So why wouldn't I want to do that rather than pay off buildings? I'd just keep taking the money out of the building as a loan, by the way.
Yep.
A loan is the key, because then it's not taxable.
Right.
And just keep rolling, like growing.
We've got a rule. We don't leverage things we're not willing to lose. And so if we've built something, we build a base. We do things in blocks. We've got these blocks. So we built the first base, it was 20 million. Now we're over that in real estate. But we get the 20 million paid off, and then we go to 50, and then we pay it off, and then we go to 100 and pay it off. Nobody's doing it like that. People are just cash players, or they're just debt players, and they borrow till they drop.
Are they doing what I'm describing?
Yeah, they're going to borrow from one to buy the next. That's great in the beginning. However, if you leverage something, you risk losing it. Stuff happens, and there's a lot of people in the $100 million, billion-dollar game right now that are losing a whole bunch of stuff because they played that game.
Well, if you have a ton of money, I would agree. Why? Because I don't need $25 million. I can keep going without that $25 million.
Yep.
So I'm going to let that just sit there and park its ass there. Number one, the $25 million is insured because the property's insured. Number two, it's probably growing, right? So why not just park it there? I see what you're saying, but that's if you have a shit ton of money. What if you don't?
Well, then you play the game that we're playing, and you just have to solve for how do I buy, how do I never lose it? It's that creative debt piece. How do you get debt products? And this is where people get stuck. The biggest bottleneck in real estate is the inability to get cash flowing debt. Period. That's it. People can't figure out how to get more debt that brings positive yield. There's this thing called a factor rate, which is, we can go into that later, but people look at the interest rate and they're like, if I make 6% and I earn 7%, I'll make money. But that's not true, because you have amortization. If you borrow a 6 on a 30-year AM, you have to make 7.2% before you break even. And people don't look at it like that. And so like, you just have to look at that positive cash flowing debt. And if you can get that with the actual margin, then you can grow. And if you can't, then you're stuck.
So you were 19 years old, right?
Yeah.
Obviously graduated high school already. You had $3,000. Where'd that come from?
Well, that was working as a gymnastics coach.
So you had $3,000 saved up.
Yep.
And you wanted to help your mom. Why would you want to help your mom?
Yeah. So my parents split when I was 8. It was in 2008. And financially, my dad did better off than my mom. And so she helped raise me, great mom, so I want to be able to give back.
Well, of course. But I mean, like, so she wasn't making any money. She was like poor.
For a while.
And you said, I got to help mom.
Well, that's the goal. Yeah.
So you said, let me go do real estate. But something prompted you to do that.
Oh, absolutely. 14 years old, a family friend of my mom gave me a book, Rich Dad, Poor Dad. Read the book, got jacked on the idea of buying a duplex. And I realized I was 14.
Understanding the cash flow perspective.
Yeah, just the idea of, hey, I can earn money. I like cars. And I was like, I can get this to pay for the car someday. And I wanted to get a McLaren. So that was the thought process in the very beginning.
Do you have one yet?
No.
How come?
Paying off obligations.
I know, but like you could go get a little bit of a loan on some equity. You got any equity in that all those buildings?
Absolutely. We're sub 60% leveraged.
Why don't you just go get a little chump change?
Next year. We took on some adventures. We bought a resort that was built by the Disney crew back in the 30s.
Oh, wow.
Yeah, it was fun. It's on the Hood Canal. It's a cool piece of history. But we're throwing a lot of money at that right now. We got to throw...
So you're being responsible.
Something like that, trying to be. But we're going to throw about $900,000 at that this year to knock out some obligations, and then I'm going to buy the car.
Okay, so you're 19, you're 14, your relative gave you Rich Dad, Poor Dad. You said, hey, this could be a way, and...
It was a friend of my mom's, yeah, and he gave me the book, and I thought, this is really cool. But I put the book back down because I realized at 14 that wasn't feasible. At 18 years old, I was getting out of high school, and the last day of school, my civics teacher, he was also an attorney, he's teaching us about torts and all this, and he said, come to last day of school, and I'll teach you how to make money when you sleep. And he told us about how he bought all these $5,000 houses in Tacoma. They got me interested in real estate again. Now the houses now are like $400,000, $500,000 at that time, but the idea remained the same. So I was helping people around their place. My dad's friend had a contractor over at his house, and I was helping them clean up their place. and he invited me to a real estate group online. So I put in the real estate group, hey, I'm 18 years old, which I was at the time. I want to get a duplex by 21. I'm working at the YMCA, coaching gymnastics, just applied for Safeway and just applied for Target. Want to work 3 jobs, save, get a duplex. Does anybody have any advice? Someone said, trash that. Just come work for me as a real estate agent. You make a bunch of money, and I'll show you how to play the game. And that was my intro to the real estate space. Just someone I didn't know reaching out. They took a leap of faith with me. I didn't end up making any money for a while, but I got into the game. And
because he was having you sell real estate, yeah?
Yeah, and I wasn't
selling. Is not the same as what you did.
Oh, no, it's not. There was 6 months I didn't make any money. And then I sold a little duplex. One of my gymnastics buddies called me up 10 o'clock at night, asked if I could help him buy a house. And I said, buy a duplex instead. He's super stoked that he did that now. I mean, it did really well. But sold a little mobile home after that. And then I bought a 12-plex, 0 money down. It was on the market, on the MLS for 551 days.
See, I wish I could find these.
You can't find them.
How?
Well, I find them on Google Maps.
How do you go on Google Maps and find kick-ass deals?
Well, every property you want to buy is on Google Maps. So you just figure out whose building is that? How do I reach out to them? Everybody's phone number's on Google.
So you're saying try, you mean?
Yeah.
So all you got to do is try?
Yeah.
Because I drove by a couple of units on the way to my house. Mm-hmm. And I'm like, I wish I owned those.
Give me the address. I'll get their number.
But there's a bunch of them. I don't think people are going to go, oh, yeah, give me $2,800 down and take over my note and you can have it.
Well, a lot of players, I mean, there's debt markets and there's equity markets. Grant County, where I got started, is an equity market. Seattle's a debt market. And that's the 2 different trains of thought. Some people borrow till they drop. Other people pay their stuff off. And the big players, the hundreds of millions, the $1 billion plus people that I met with pay their stuff off. So I started.
Are you looking for those kind of people?
Absolutely. I just get to learn from them. If I get one takeaway from everybody I meet, I'm better off. And that's all I care about. And so I'm reaching out, trying to learn their story, map it out, share mine, and then we find relatable points, start building that relationship. And what I found from building a relationship is if you get a takeaway from someone, you apply and let them know it worked. That's the quickest way to build trust. So that's what I've been doing with all these people. Get a takeaway, apply it, buy the real estate, let them know it worked, and then that builds a really tight relationship with them. And it doesn't matter whether they're 100 million, billion, or they got less rentals than me. If I just get a takeaway, I can grow. And if I don't, that's on me.
Dude, I have less rentals than you. Like, I need some rentals, damn it.
Let's get you some rentals.
Dude, I don't know how.
Well, send me an address. I'll show you.
I mean, I do know how. To me, it's like, who's going to fix the toilets if the shit breaks? It's all these questions I have, which you could easily answer.
Absolutely.
But because you've done it, that I wouldn't know. Because there's a million people listening to this. Why wouldn't everybody go get a bunch of equity and buildings and, doors? Why wouldn't everybody do it?
Ambiguity kills deals. I mean, when there's ambiguity, you just get too much in your head. Slows you down, you get into deal fatigue, and then you quit. That is what.
Well, again, like I said, like if you came to me and you said, Brad, we went out just to prove our point. This guy over here for this deal, all you got to do is sign here and cut that check, or sign here and do this, and then this machine will start paying you money, and plus it'll go up in value. Mm-hmm. Who wouldn't do that?
I don't think anybody wouldn't do it.
There's people that say, I don't have the credit. The bank won't loan me the money. So that's why I don't do it. Mm-hmm. I don't have the money. So I can't write the check down, or I don't believe anyone's going to do it for free.
Right.
No money out of my pocket. So how does that work? Well, you're saying, we'll go borrow it from your granddad. There's people that don't have anyone they can borrow from.
Well, I didn't borrow from family. I didn't have it either.
You found a deal that with $3,000 was sufficient.
Well, I didn't even spend my $3,000. That's the fun part.
So how'd you structure the deal?
So it's deal debt equity. 12 units. It was making $9,730 a month, day one.
And you saw that on the rent rolls?
That was on the rent rolls. It was on the MLS.
Did you look back a year, 2 years?
Nope. I just looked at the rent roll. I don't care about the 2 years ago's income because I know it was less. I do care about the expenses, so I want to see trailing 12 of expenses, trailing 12 months. However, last 3 months of income is sufficient for me in a rent roll. I saw it. I saw the income. And the way I structured it, I got 90% seller finance from the seller. That was first lien position.
Because he owned it free and clear?
Yep. They bought it at, I think it was like 21 or 22.
And what interest rate?
6%.
That's a strong interest rate.
It was all right. But that was back in 2019 when people were getting 4% debt. And so,
okay, so you were overpaying. You were willing to overpay.
Yeah, it was a 30-year fixed rate mortgage, no balloon. So it's going to pay itself off like a house. Just fixed rate. I fixed the variables. That was the one piece I needed.
That's what he agreed to.
Yep.
But you made that a point.
Yeah, that was the goal. It was just, I need this to be fixed because I wasn't bankable. Now I am, but I wasn't then. And so I signed that deal and I didn't have the money. The problem was I was buying it for $1,125,000. I was getting a loan for $1,012,500 and I need to come up with $112,500, that gap. Well, people get stuck with, I don't have the credit. That's why I need to find the deal first. I found an opportunity. Then I negotiated the debt. This is the simplicity of the game. We try and keep it super simple. You find the deal, then you find the debt, the big piece. So I got the 90%. If you can get 90% of the money, it's a lot easier to find the 10. But if you can't get that, you're stuck. So you have to.
Why 90?
Well, I mean, it's better than 80. I'd rather come up with 10 than 20.
But you can get 80 pretty easily, right? Any bank will give you 80.
I don't think so. Not at 19 years old with no money. Even if I had an equity partner, I don't have the experience to buy a 12-plex. I'm not going to qualify.
Banks look at do you have anything now as part of the decision?
The decision?
Yeah, like there's a decision to loan you that money.
Oh, yeah. Like as far as getting bank loans now, yeah, I've got over $3 million of bank debt today.
Right, but they look at, because I was told by Grant Cardone, you know Grant Cardone,
yeah,
obviously.
We've met up. He connected me with you.
Yeah, so I've asked Grant, I've watched him do what he's done. And I asked him, and he said, banks aren't looking at your credit to buy a building, like a commercial multifamily unit, because it's a business and they're looking at the cash flow. So if you find a deal where there's cash flow, any bank will give anybody damn near 80%, but they want to see that you've done it before. In other words, they don't do it to anybody because I've never owned units. You just said the same thing. I've never had 12 units, so I'm not bankable.
Yeah, you're going to need the experience typically for these
So
products.
they look to see if you've ever owned buildings before.
Yep. Depending on the debt product. There's some small credit unions that will give you the loan. Just say,
No matter what?
Yeah.
Have you ever found a deal where the bank would loan, in other words, the person was asking under what it was worth?
Oh, yeah. I bought assets for below market value.
And then the bank can finance the whole thing.
I'm sure, but at the end of the day, I don't think that's feasible for most people, and I don't think with the current rate environment that's going to cash flow.
Do you think if I picked up the phone and started trying, how long would it take for me to find one of those deals right here in Las Vegas, Nevada?
Like 45 days to be under contract.
It takes a long time then.
It's not like clicking a button. We're not day trading.
How are you finding them?
Google Maps.
You just go on Google Maps. Are you looking for homes that have overgrown yards? People aren't taking care of the property? What?
I don't buy houses.
Well, buildings have overgrown yards too, don't they?
Yeah, but I'm looking for people that have mastered the game. I don't want to learn from people that are losing. That's the reason I don't do the whole subject to model. Subject to relies on the bottom of the barrel of the business. It's people that are typically not doing well. Just as a holistic view of it. Seller financing, people have equity. They're not in distress. So I'm not calling people that have distressed properties.
How do you quickly determine whether it's seller financing?
Well,
hey, would you consider seller financing?
I ask. Would you hold a contract?
Yep. The more you add to it, the less likely you are to get it every time. You go through the deal, you talk about the property, you understand it, you just treat them like a normal person, you're capable of buying the property. And the question is, are you open to holding a contract?
And if they say yes, what if they say no? You say, okay, thanks anyway?
I'd still love to meet up for coffee. I want to learn how you did this.
Did what?
Bought these assets. That's something that people
So you ask them, how did you buy your asset?
How did you build the portfolio? Like, at what point in your business cycle did things click? What point in the business cycle did it change for you?
Well, like I got a buddy of mine. He buys a piece of land.
Mm-hmm.
The bank basically gives him the money to build the building because he's got it pre-leased to a massive company.
That's huge.
Like for example, Chevron.
Mm-hmm.
So Chevron will say, you go build me this gas station and I'll lease it for X amount of time. So he gets the property, which automatically means that the bank will build it for him for free, basically. And then he leases it out. And then like within 1 or 2 years, he can sell that thing for ridiculous amount of money because of the lease from Chevron.
Absolutely. If that's the business model, that's the business model. And that's why I want to meet with all these people that are doing well, because I get to learn how they play the game at a higher level. Our company, and we work with you on Lightspeed, it's multifamily strategy. Strategy is you meet with the people that own the multifamily buildings in the market you want to own in, learn how they did it, and repeat it. You meet with the players, repeat it, and then you become a player.
Multifamily Strategies. That's I saw that on the reports the other day. You guys are selling shit too.
We are.
Yeah, you're doing pretty good actually.
Trying our best.
I can help you with that. After we get off this, I'll talk to you about something that probably help you with that.
Yeah.
But so ultimately though, if somebody's sitting here listening to this, you know, a 19-year-old kid with $3,000, no real experience in anything, who's now still only 23.
Yeah.
But you've obviously demonstrated that the shit works. Now, is there going to be somebody that calls you and says, "Hey, okay, I want to learn how to do this," and then you say, "Well, you can't." Like, does everyone qualify?
Everybody qualifies.
Everyone can do it.
It's so simple. People overcomplicate it. They get,
Aren't you wondering why more people don't do it?
They don't know about it.
They don't teach this in school.
Well,
they don't teach anything about money in school.
Beyond that, because that's all over the internet. Nobody teaches it in school. I mean, that's great, but everyone knows that. Everybody is afraid of talking with people. It's ridiculous. And I know this because that was me. I was super nervous, but when I met with my first owner, I called him up out of the blue, and I drove 3 hours to meet with him for like 5 minutes. And then I drove 3 hours home. And I called him up and let him know the thing that he taught me worked. And that was it. And then
I know, but where do you get the property? Because I don't want to go meet with people and find out how they did it. Like, that's not my goal. My goal is to go meet with you and get your building.
Yeah. Well, I find it on Google Maps. It's the aerial view. You find the big roof. Big roof's more likely to be multifamily. And I find the big multifamily buildings. I figure out who owns it, what's their city, like, for their business based out of. And if you put in the person's name, the city they're based out of, and phone number, their phone number will pop up 95% of the time.
Does mine?
That's how I texted you. I didn't get your number from Cardone. I just got it off the first page of Google. And I sent you a text, asked for 2 minutes, and you called me up. I was in Miami, right next to a loud drawbridge, and said, "You asked for 2 minutes. Here's 120 seconds. Go." And that got us to here.
Yep. Although I did forget, because I said, "How the fuck these guys get on my show?"
Ta-da.
That's all right.
But good enough. When I read, started with 3,000, now it has a bunch of units. Young kid. It's like, we'll see. Like, that's the type of guests I am looking for. Why? Because that's the type of people that will show the Bomb Squad, which is all the listeners, how to do something.
Yep.
And me, quite frankly, because again, like, I'm fascinated by, you only have 3,000 because I got a fuckload more than 3,000. So, like, shouldn't I be able to do a massive freaking thing? Well, sure, but why am I not? Is the question. Because I don't know how.
It's the bottleneck of the debt.
What if I bought your courses, or I know how to get in your system.
Yeah, you
anyway.
I actually might have an idea how to do that.
Yeah, but what if I went through your courses with the money I have and the credit I have and the resources I have? Could I have 1,000 units in a year?
Without a doubt. I mean, depending on your, wherewithal.
But I mean, you got to find the deals. The point.
Yeah, or you have to have the person that can find the deal. That's where the relationships matter. I mean, that's
so.
where.
Why don't I just hire you guys and
That's where it
you
gets
go
really
find
fun.
me all my deals.
That's why I'm so stoked to be here, to finally meet you in person, because now we get to start building that relationship and growing together like that.
Well, again, I will build a relationship with anyone that finds me the deal. I told someone that the other day, and someone emailed me about that Nashville house. Mm-hmm. But did I tell you or the guest before?
You just told me about that house.
Yeah,
I wouldn't buy that.
Yeah, well, again, I mean, to me, it's not about multifamily or an investment. That was just because, like I said, if anybody on an episode, if anybody knows someone that'll do creative financing for a big ass house in Nashville, because I was thinking about moving there, let me know. Because I was talking to Pace Morby, and I was just kind of throwing it out there. But sure enough, dude, someone did call me, and there is someone there with not a mansion, but there's people there with deals, is my point. So there are deals out there. The question is how do you find them? Because if I knew exactly how to find these deals, I'd probably hire a kid to find them for me. Meaning, okay, here's what you do all day long. Just call these people, say this, and when you get a yes, let me know. And then quit talking to him for 30 days. And then all of a sudden he'll say, "Yeah, I found one." And you'll be like, "You did?" You go and look, and it's like, "So I can get 36 units for freaking da-da-da-da-da-da-da-da." What math do you put yourself through to see if it's a good deal or not?
Yeah, so there's just a couple numbers I care about. I need to know what's the true cost of capital and what's the net operating income. That's all that matters.
So the net operating income is basically your gross revenue from receipts minus the expenses that you're paying.
Of the building. That does not include debt, because
how do you know it doesn't need a new roof, and how do you know it doesn't have termites, and how do you know when you buy it you don't find out it needs $300,000 worth of shit?
You don't. But you're not there yet, so don't worry about it. And people are asking the wrong questions too early. They're getting stuck, and that gets them out of these deals. We bought a deal and we didn't even do an inspection because we didn't need to pay someone $10,000 to tell us everything was wrong. Like, things are going to be wrong. But if you're asking all those questions, you're going to strike out too soon before they even throw the pitch. And that's the problem. You got to go in. How do I buy it? Is that you find the deal, which is on Google Maps. You call them up. People are asking for the wrong things. They're asking for the sale over the phone. No, if you're going to buy a 100-unit deal here, I mean, maybe it's $200,000 a door, $20 million. So you buy a $20 million asset. If they finance 90%, you're getting $18 million from them. They're not going to give you $18 million over one phone call. You have to book a coffee meeting. So people are asking the wrong things. You find that property on Google Maps, you call them up, ask for the coffee meeting, start cultivating that relationship, let them know your goals and what changes when you get there. Not the why, like not why you're doing stuff, but what changes when you hit your goal, what feasibly moves the needle in your life. And at that point, and you map out their story and their goals, that's where you get these opportunities. That's where you're not doing that, but you have someone that does it for you, build that relationship, you build the trust, and then that's where you can get those $18 million loans. You can start building the portfolio from there.
But why wouldn't you just talk the owner into getting a loan from the bank so they can get their money up front and in advance, and then you just will pay the debt on the loan?
Well, I mean, maybe they don't want the money. I mean, people have more money than they have life sometimes. They get to that point in the cycle. And if they're going to die, which everybody's going to die, but if they're getting closer to that, they'd rather pass a note to their kids than a wad of cash or a property, because their kids can soil the property and they can blow the cash. But an $18 million loan, if you're at like 5% interest only, it's $75,000 a month. The kids could blow $75,000 every single month, and they'll get it again next month on the 1st. And so that is more attractive for them. All the people that we're buying deals from, they did 5-year notes, 5-year loans. However,
did they tell you have to pay this off within 5 years?
Mm-hmm. However, we have clauses in there where we can just extend it another 10, 15 years. If they start aging out, if they have a medical issue, there's a couple partners, they're just going to automatically kick it out because they don't want to give their kids property and they don't want to give their kids cash. That's the reason these big deals are going to move like this. And this is what people aren't thinking about. Like I talked about this with Cardell. He said, you're going to have difficulty scaling. But what he's not seeing is that there's some people that actually pay all their stuff off. How do you 1031 a $2 billion portfolio? You don't. There is no exit. Yes, there are more systems.
You can sell it as a REIT.
You could, but then you still got to figure out who's going to manage it. Like
well, that would be the buyer's problem.
Yeah. But at the end of the day, do you want all that cash? Because where are you going to put it?
Well, yeah, but now you're talking real high level shit that people definitely don't think about because they've never had that kind of cash.
I've never had that kind of cash, but I'm looking into the future and saying, this is the future opportunity. Again, the bottleneck in real estate is cash flowing long-term fixed rate debt.
Dude, you make me want to like get off this episode and go start getting on Google Maps, finding properties.
We'll chat about it after
where
this episode.
I can call up the owner and be like, hey, let me ask you a question. Are you open to holding a contract?
There's one more reason I wouldn't go with a bank on some deals. Like the first deal we did together, 38 units, $2 million purchase in Washington State.
It's on the market since I was 8 years old, bought it when I was 21.
13 years on market. The property itself.
Why did nobody want it?
Because it's a turd of a property.
It was a negative cap rate deal. Cap rate is your cash on cash return if you paid cash. You could write a check for $2 million and you would lose $20,000 a year.
So if you brought that deal to the bank's going to say, no, we're not going to finance that. It doesn't make sense.
Because the expenses were more than the rent.
Yep.
Exactly. Which is,
but why didn't the previous owner fix that?
Half of the building was occupied by the previous owner's family. And they kept rent super low. So they never had the money to fix it.
I know, but okay, so basically they did it to themselves.
Yep, over the course of 30 years.
Because at the end of the day, when I buy it, I walk in, they're not my family, and you guys are paying the same as everybody what the market allows, which is $800. And by the way, I'm going to start picking up your garbage, which is why rent's $850 now.
Mm-hmm. And market rent in that area is $1,250.
Well, then I'd get it figured out how to get it to $1,250.
Absolutely, and that's the play. We underwrote the deal at $700 rents.
Is it paint, grass, upgrades? How do you get the rent up?
So the thing we go in first is we go into everybody who is number one not paying and say, is there anything you need fixed? We had a whole bunch of people not paying. And we asked,
what if they just can't pay?
Well, if they can't pay, then we're going to have to work with them with the government and probably place them somewhere else. But we're not just going to kick them out. If they're not paying, we get it, but they're people. and we need money because we have debt. And so we went in and said, hey, do you need anything? Everyone else would have gone and kicked them out. We bought them new refrigerators, new stoves, fixed their heating, and just gave them everything they needed. And like that, they started paying. Not only did they start paying, they paid a 33% rent bump, which got our valuation in 9 months from $2 million to $3.4 million on appraisal.
Now, see, why wouldn't you be able to now go borrow 80% of that and pay off the building?
You can't borrow 80% in most markets in Washington because of the function of cash flow. We're looking in the 6% debt range, meaning that your cap rate's going to have to be in the 9s if you're going to go 80%. And that's not feasible. Your cash on cash return will not be high enough to service the debt. So you're not
Explain to people what cash on cash return means.
So if I throw $100,000 down on a deal and I get $8,000 in free cash flow because I bought a house in Tennessee, that's an 8% cash on cash return. I threw out $100,000 and at the end of the year I had $8,000 of net income I could blow on whatever I want. Throw $1 million down on a deal and get $80,000, it's the same return. But the cash on cash return, or your cap rate, which is really more important.
Is that what a cap rate is? A cash on cash return?
If you pay cash, yeah. And so if I buy $1 million building,
nobody really does though.
Correct. However, it's a way to compare apples to apples. Everybody pays cash; it's just not their cash. And this is the simplicity of the game. You're borrowing money from someone, and typically, whether it's a bank, whether it's private, hard money, whatever, but you're paying cash for every deal you get. And so if your cap rate is the dividends it produced expressed as a percentage, what is your cost of capital expressed as a percentage? Nobody does that. They're like,
what is it? How do you figure that out?
That's called a loan factor rate. Everyone looks at the interest rate, but the interest rate's irrelevant because you have this thing called debt paydown, amortization. Could be interest only. So if you're buying a deal, $1 million, and the NOI is $80,000, your net operating income, that's the money you have to pay yourself and pay your mortgage. Well, if the cost of capital is 7.2%, then you're going to make a 0.08% spread on every dollar you borrow. That's positive leverage. If your cost of capital is 9%, then you're going to lose a point on every dollar you borrow. That's why in markets like San Diego or anywhere in California, really, where your cap rates, your cash on cash return is so low, you have to put 45, 55% down because the bank sees you're going to lose money on every dollar you borrow. The difficulty is you still want to buy the deal and we still want to place the loan. So you're just going to have to put more money down, borrow less money. The 4 ways to improve cash flow is optimize the real estate or optimize the debt. You can either increase income, decrease expenses, which could be debt, borrow less money or borrow cheaper money. Those are the only ways to increase cash flow. And if you have low cash flow, you can't borrow 80%. So you have to make sure your true cost of capital is less, and that's a factor rate. It's just what's the annual mortgage cost divided by the loan amount. That's it. That's the equation.
What does that come up with?
That's your percentage. That's the actual cost of capital.
So
if you have $1 million loan,
if that on that one you're talking about, there's $80,000 a year. Mm-hmm. That would be.
So if you bought it for $1 million and it does $80,000 a year net operating income, you can do it on mortgage calculator. People that are watching this, but 6% interest on a 30-year AM. It's like a house loan. Your payment's going to be about $6,000 a month.
Okay,
that's great.
That's $72,000 a year.
$72,000 a year. So while the interest rate is 6%, $72,000 a year on your loan amount of $1 million is 7.2%. That's your actual cost of capital. Interest plus principal pay down times 12 expressed as a percentage, because now we get to look at apples to apples. It's not.
So I just figured out my cost of the money.
Yep, that's the true cost of capital expressed as a percentage. And the reason you have to do that is you have to look at, well, if I have my dividends as a percentage, I need to look at what's the actual cost as a percentage, because now I know if I'm making positive or negative spread.
So if you're making 8% here and you're paying 7.2% here, you're making 0.8%.
And now I want to borrow as much money as possible. However, if I was buying at a 7% cap rate, I would lose 0.2%.
Who does that though? Why wouldn't you just pass on that deal?
Well, some people want appreciation. There's equity growth people and there's cash flow people. I buy based on cash flow for equity growth. I'm buying these deals. I know I can manipulate the value by getting the net income up because the next person will pay more. Even though I'm not going to sell it, they would pay more, so the value goes up. And I'm buying based on the cash flow. So I can't just buy for equity growth. Some people are going to go in, they'll say, I'll float $1,000 a month or $10,000 a month, whatever it is, just to own this asset. I can't do that. I don't have the money. Like, we're getting there. We've floated a lot of real estate through renovations. I mean, we've done $1 million in reno last year. But we had to
build. Where'd you get that money?
Cash flow from the real estate. We had to buy based on the cash flow for the equity growth. And as we go in, we got our property up. I mentioned we got it from 2 million to 3.4.
But at some point you have to, like, for example, let's say I buy this building.
Yeah.
I get a good deal. Now it needs all new floors. Well, that's, for example, $6,000 a unit.
Yeah.
And there's 30 units. Well, where am I coming up with 180 grand to fix the floors to make an improvement?
You better figure out how to boost your equity. The optimization phase of our business cycle.
You boost equity by
getting the net
increasing
income up.
the rent.
But so maybe let's say we're at $600 rents on our asset right now. We did rent bumps from 400 to 600, which was awesome. And we had some people go from 5 to 6.
Just for nothing. You didn't fix a floor. You didn't add nothing.
Anybody can afford. I mean, most people can afford $600 rents.
So you buy a building, bro. That rent's going up.
Changed a few appliances, showed a little bit of love, but I mean, it was basically.
I know, but changed a few appliances. That takes money.
It does.
What if someone doesn't have money?
If you can figure out how to buy the asset, if you own a $2 million building, you can get a $20,000 credit card.
But what if you can't?
You can't.
Because I always think about and focus on the extreme. Why? Well, because when you say you can do this with basically no money down. Well, but can you? Because if you go bing and then all of a sudden it's like, well, now you need to buy appliances. Well, I don't have money. Well,
okay. Well, we'll go back to my.
If you don't have money, you can't raise rent. Can't raise rent. Can't increase value. Can't increase value. Can't get the loan. Can't get the loan. Can't get that. And all of a sudden, the shit don't work.
Don't rock the boat. Money. Don't rock the boat if you can't get wet.
But you need money, correct?
Eventually, but it doesn't have to.
How much money you need?
Depends on the deal. Our 38 plex, we got the asset value up to 3.4. We did some more stabilization, and we pulled out $500,000 for that building.
And used it to spruce it up?
Just for that building. But that's because we took the rent from basically nothing to $600. We've got some over there, 1,000 right now. Not many.
Did anybody freak out and get pissed and piss backwards?
No, because we take care of it. We have the reputation in that town as being one of the top landlords because we keep rents affordable, but our stuff is nicer than everyone else's who's more expensive because we don't need it to be there to get our deal done. We'll get there eventually, but all the people we learned from paid all their stuff off, so they don't need to do it. We're taking that as a takeaway from them. We're repeating it. That builds trust, and then they sell us more deals, which gives us more market share.
So where's this dude come in? He's just your buddy?
I got started 2019. Fast forward to 2021, I meet Christian. He's heading up a call center. He gets this thing profitable, and then the owner of that company shuts it down.
Same month we hit profitability.
So we say, F this, we're done. And
why'd you say we?
Well,
you weren't working there.
No, we went to a growth conference together, 2021. And we set
Which one?
That was with Grant Cardone.
The 10X.
Yep, 10X Growth Con. And we were in Florida, and we got amped up, as most people do when they go to those things. And we said, you know what, let's get to 100 units in 2 years. Well, fast forward 11 months into that partnership, we get 100 plus units in a resort. We bought it with.
So you guys both started out and said, hey, let's just do this together?
He had 2 duplexes in a house. I had 30 apartments.
But if you, for example, found a unit with no money down, I'll go in on that with you. I'll be your partner.
Absolutely.
So how'd you say, well, we're just going to be partners on whatever we find?
So I started with just a little bit of capital, which we blew through basically immediately.
He blew it on his duplexes.
Yep, I blew it on my duplexes, and I realized, okay, so this kid has 30 units. I have a bunch of business experience. I've started companies. I've employed people. I've run stuff. But all that work has yielded 4 units and the house I live in. So whatever this guy's doing, I want to figure out. He's like, well, I just figured out how to move the money without going through the banks or earning it. And I was like, well, that sounds better. I had this goal of getting to 30 units by 30 years old. I was 29 at this time with 4. And so I asked Cody, how the heck did you do this? He's like, well, I can help you get there because I want to buy this 38 plex. So that's not going to put you at 30. It's going to get you to 42. So I guess I can't help you. But if you want to do this deal with me, I can't run this by myself. I need an operator. We talk about it, how do you own it and how do you never lose it? Those are the 2 pieces to buy and hold real estate. Cody is the single best buyer of real estate, I think, in the U.S. He's insane. I'm a pretty decent operator, and I would say a little better than decent. And so the employees, the maintenance, the coordination, how do you operate and maintain this much property? I run the business side, he runs the acquisition side, and he is a freak of nature at his job.
So when it comes like, it needs a new window, they call you?
They call me, or now they call my wife. She was a school teacher. My why for getting started was I wanted to retire her.
Took 11 months.
Yep, it was going to be a 5 to 10 year goal, and then the whole country shut down and schools got even weirder. And I was like, well, my 10-year goal just became a
Now.
Yeah. Right now, let's get her out.
So when you guys go back home, are you out hunting for deals every day?
I'm not currently. We're in optimization phase. So you do build phase, you stabilize it, and your build phase is just you go out and build to the first goal. If you want to get to 1,000 units this year, you don't stop buying. If you can figure out how do I buy it and how do I never lose it, as long as it keeps increasing cash flow with long-term fixed rate debt, you buy it.
What's an average door worth?
Well, we've got...
and I'll tell you how many doors I want.
Yeah, so let's say our portfolio, $24 million, have 122 units. And we got a resort, which is worth about $6 million. So our average door is just a little south of $100,000
a year.
$100,000 in price per unit.
Yeah, but what is it worth?
As far as income?
Yeah.
Yeah.
That's what it's all about, isn't it? Cash flow.
Yeah, each unit cash flow is about $900 stabilized
a year
per month. So 10.8.
So the average door is making you $900 a month.
Yeah.
So if that were true for me, I would want 5,000 doors.
Okay.
Now, how do I get 5,000 doors by the end of the year?
Well, 5,000 doors, $900 a month. What is that? $450,000 a month?
No,
Yeah.
4.5.
$4.5 million a month.
Oh, yeah.
So, $52 million a year. If you're earning 5% on your money, which is probably fair on market value, you need $1 billion equity.
So you just got to go find $1 billion in deals.
No. You need to buy $4 billion of deals and raise the asset value 25%. Because if you buy 100% leverage $4 billion of deals, you get the asset value of 25%, which is probably just raising around $100, maybe $150.
But why don't the current owners do the same shit?
Why do they need to? If they got $100 million, a mom and pop owner, like I know a lot of mom and pop owners, they've got $100 million, nobody knows about it, and they don't care. They started with nothing.
So that's the answer. Then they don't care because like I'm assuming they just don't know how to do this. Like if you came to me and I have this building and I sell it to you and then you turn around and make it worth 10 times more than I had the fucking thing, I would have thought, God, why didn't I just do that? Then I could have sold it to you for 10 times more.
But at what point does it not matter?
And what point doesn't it not work? Like you buy my building and you can't raise the rent anymore. It's already at the max.
It'll go up over time. But that's the long-term play. It's like, are you buying stabilized asset or are you buying an opportunity where you can go in and get it to be more optimized than it currently is?
Have you guys ever bought a property where you lost money?
No. Because we buy based on cash flow for equity growth. So we're buying opportunities where it cash flows day one. If you just increase your net income, and you've done this with Lightspeed, but if you just increase your net income every single year, it's very difficult to go broke.
True. What about, damn, I had a good question. This is why I interrupt people, because if I don't ask when I think of it, I'll forget it. We'll keep going. I'll think of it again. But it was a good question. I know people would want to know the answer to that.
Well, it's also why we fix as many variables as we can. That's why it's all about long-term fixed rate cash flowing debt. And like banks can't call our notes because we don't have a lot of bank notes. We've done some bank refis, but we have never acquired a property through a bank, which means we get to set our price, we get to set our interest, we get to set our balloons. It's all negotiable.
Do you have all the agreements one would need?
Absolutely. It's
pre-written.
It's super simple. Well, we get everything drafted per deal basis.
Where's your training system located? Multifamily Secrets, you said?
Multifamilystrategy.com.
Multifamilystrategy.com.
There's no secrets in this business.
But that's where people would go if they wanted to learn from you guys and start getting their own properties.
Absolutely.
Which again, I mean, I don't know why anybody wouldn't. Now, if I acted on yours as opposed to all the other people that come through here with essentially the same story, but to me, it's like yours seems clearer for some reason.
It's simple. People overcomplicate it. They worry about too many things too early.
So I mean, if I'm listening to this and I go to multifamilystrategy.com, I sign up for your course or whatever it is, your program or whatever you're doing. Within a year, literally, I could have 100 units, 50 units.
Whatever the target is.
And if it's $900 a unit, that means in a year I had 50 units, 900 times 50.
Right.
Fuck, that's $45,000 a month
in net operating income. And now you got to figure out.
But that's a nice little chunk of change. Now, most people think, well, I can use that to live on. Not if you want to grow, right?
Yep. And probably 60% of that will be your debt in the beginning. So
so ultimately, you're not netting $45,000 a month.
Not on that deal, no. I mean, we are stabilized, but you're not going to do it in that situation. So
how long does it take to get stabilized?
12 to 18 months, realistically.
So when you buy a deal, you probably shouldn't expect any money for a while.
I wouldn't. This is a hard realization for some of our mentees. I mean, we've got kids younger than me, 19 years old. They had 28 apartments. They live in San Diego. They said, I hate this state. So they started buying in Texas. They bought 2 10s and an 8-plex, seller financed, 0 money down. And they're cash flowing, which is great, but they're not rich yet. That was like your video. You said,
well, give it time. They'll wait.
Yeah, you could be a millionaire, but show me your bank account, right? $300, you're not a millionaire. Like I love that, but that's like them right now. They're super cash poor, but they have equity in these assets, and it's just going to take.
Equity is value, though.
It is valuable, but it doesn't pay the bills.
It doesn't pay the bills.
So they're doing fine, but you can do this anywhere. They're doing it in Texas. We've got people doing it in Maine. We have people that did it.
What are the best states to do it in?
The state you're comfortable with buying in, because if you're uncomfortable,
I'm
you're not going to buy
in
anything.
any of them.
I hate Washington as far as ownership goes, but I have a footprint there now, and I'm well known with Christian in the markets we buy in. We are known as the best operators in that area, and so we're going to keep buying there. However, we will start moving into some warmer states because we want to visit properties where it's a little bit nicer weather. We like.
Do you have to visit properties?
We like to.
I've met a lot of owners who don't visit their properties, and they tend to be the ones who post the videos online saying how I lost $25,000 on this deal,
and they're also buying small stuff. But
yeah, but they're the ones who typically lose or find, oh gosh, I didn't realize these problems were happening. My property manager stole from me. You got to be looking at the real estate. It's not passive. You make money by being a better operator than the last guy.
So if I bought 3 things in Nashville, I'd have to go to Nashville and check them out once in a while.
I'd check it out at least the first time and then build systems so you don't have to. The problem you're going to have if you go buy in Nashville is you likely start out with something that's too small that'll never make enough money to warrant owning it. And that's where most people get stuck.
Why? Why would it have to be too small?
Well, let's say that you started with a deal and say it was like 50 units. 50 units, average net operating income on a deal over there, maybe $700. So you have $35,000 a month. If it was paid off, well, $35,000 a month is great, but if you want to get to $4.5 million a month, that's too small to buy. And because you're going to have to flip that up into something bigger. It doesn't make sense to hold it in the long term. So that is the only issue you may run into if you buy out of area. If you buy down the street, it doesn't matter what size it is, you drive on the way to here. But if you're buying somewhere else, $35,000 a month, if it was paid off, you had no debt. It's like, that's great, but it's nowhere close to your goal.
Well, I would tell anybody that still has questions to go to the website and figure that out.
Absolutely.
My only question again is still like, how do you find the deals? You can't. Google Maps. Okay, I know where Google Maps are, but I don't know how to find deals on Google Maps.
Yeah.
You just pick a neighborhood you like and start looking at rooftops, and if they're big, find out who owns it by searching their name.
That is the simplicity of this game. You can go on sites like LoopNet, Crexy, but look, those are deal graveyards. People make the argument all the time. Well, that's where you find your broker connections. The good brokers are going to be making the calls to people that are playing the game. So don't add steps. It's our number one rule in business. You do not add steps.
Do you have a lot of brokers reaching out to you?
We do now.
Okay, well, listen, folks, if you're listening to this and you're a broker, I'm in the deal. I'm doing deals from now on. So hit me up if you're a, what are they?
Multifamily.
No. What are they? Who hit me up? Brokers.
Real estate brokers.
Yeah, if you're a broker, bro, I'm looking. I'm willing. I'm a buyer. Now,
Yeah.
what if someone reaches out but terms aren't favorable? You just pass.
You pass. There's so many opportunities.
Will people stop giving you deals if you pass on all of them?
Not if you do it quickly. Let them know where the mistake is. Like, hey, I'd love to do this deal. This is why I can't. We didn't hit this. This is a negative cash flow.
But what if the deal's awesome, but it requires $3 million that you don't have?
How big's the deal? Because if we're doing a $30 million deal, it's easy to find that $3 million.
How?
Well, you start with the pitch. How do you structure the opportunity? I've got $27 million seller financed at 4.5%. We're going to have a 13% yield on the debt.
So you go find
Whatever it
investors, basically.
You could find an investor, but you can, again, structure as debt or equity. And if you're going to do it as debt, you have to make sure that the total cost of capital is less than the dividends the deal produces. If you're doing it as equity, you need to figure out, how do I eventually cash these guys out? Because I'm not going to partner with people forever. I think that's a stupid decision. You should have a plan to get rid of people. because people make things complicated. The only person I violate that with is with Christian, because we started this thing together. 2 years into it, we really scaled from there. But if once you have the deal, you just have to put together terms that no one else can get. Price is only an objection in the absence of value, and the value that you create with multifamily is getting terms no one else can get. That's it. So if you have the terms, if you get a $27 million loan on a $30 million piece of real estate, and it's at maybe 4%, cap rate 6, you can make a 2-point spread on that deal. Well, that's really freaking good, because you're going to make $540,000 in cash flow on the debt. That on your $3 million down, I mean, that's like 20%. It's almost 20%. And then you earn the 6% on your $3 million down, another 180 grand. You make like 25, 26% cash on cash. You can easily find $3 million. However, if you're doing a $6 million deal,
how would you find it? By just asking people with money?
You got to call up the other players in the space. This is where building those relationships.
Well, this is why that people should go to you, because if they found something like this, they could call you and say, "Dude, I found what the guy, but I don't have the $3 million," and you'd help them figure it out.
Absolutely, and we're not going to partner with mentees. We have a strict rule: we don't do that, because that's a conflict of interest of giving some people more attention than others. However, we have the people that can fund them because we built all these relationships. I can call up the guy who's worth $100, $200 million in Grant County and say, "Hey, I've got a great opportunity. I'm looking for a loan. This is what we're looking at. We can put 10% down to buy 150 units in Las Vegas. Nobody can get this debt product, and this is the opportunity." We go in at a $30 million purchase. This is my favorite part about the real estate game. If you buy a deal for $30 million, most people are putting 12 million bucks down. They have to get the asset value to a net sales price of $42 million to double their money. If we buy it for $30 million, put 10% down, we got to get to 33. And if that deal can go to 42, we're turning $3 million bucks into $15 million. That's where this starts to really blow up. And that's where we can make the pitch to an equity partner or a debt partner and say, we're going to take it from 30 million to 42. We're going to exit. We'll have a net sales price of like $38 million in that case, because 10% is going to go away to everything. And we're going to owe $27 million. If you needed to sell, that's a pretty good pitch. Someone puts in 3, they walk away with 9, and you keep the rest. Now you pocket $4 or $5 million bucks, and you're way ahead of the other people that were stuck on, well, I don't have the credit, I don't have the money.
Yeah, where'd you learn all this?
Meeting with the owners in Grant County, a little town called Moses Lake in Quincy. Called up people that I found on Google Maps. I asked them for coffee, met with them, and over the last 3.5 years of my ownership in that market, I've just learned how they played the game.
Tell me what a phone call would sound like. Ask me out for coffee like you do them.
Okay, Brad. Well, I'm going to do one better before we get there. I'm going to just show the premise, because the premise is you've done something I've never done before. I really would like to figure out how to get there. I'm starting with nothing, and I just want to know how you got there. Could we grab coffee? That is the whole premise of the phone call. It is super vulnerable.
And people take the time to go.
Absolutely.
It's almost like they want to talk about how great they did.
Well, nobody is calling people that have been like super successful and persisted to get the coffee meeting. Everyone's asking for them to sell their stuff. If people just grasp this concept, they're going to do way better. No, everyone's asking for them to sell. Everyone's asking for something. I'm offering to grab coffee and let them share their story, which their kids don't care about, which is real. I mean, everyone that I bought from, their kids don't care about the real estate. They just remember their mom and dad painting rentals with them sitting in the corner as a kid, just twiddling their thumbs, playing games. They don't have the affinity or the love for this game. And so when I call them up and I'm genuinely asking, I don't know how to do this. I don't have anybody who's ever been able to teach me this. Could we grab coffee? 20 minutes. I just want to learn how you got here. Because I don't know how I would. It's super vulnerable, but it's real. That's how I get in contact with people. And the phone call is just like the phone call that I made with you, which you don't remember. That's fine. That was a year ago. I was in Miami. I got your number. I texted you, said, hey, Grant said we should connect. Owners, no owners, business owners know business owners. He said we should connect. So I text you, found your number on Google first page. And I asked for 2 minutes. Gave me 2 minutes, and that's how we got here. So it's just being vulnerable. That was the worst phone call of my life with you, because when you called me back, there was a drawbridge going off and it was dinging in my ear, and I could barely hear you, but I was trying to get through the conversation.
Worst call ever is Bradley. Appreciate that.
Yeah, but here we are. It still works. That's how simple this game is. I was just being genuine. Hey, I want to meet with you. You recommended that I get on your product on Lightspeed. We got on your product. We crushed $500,000 in the first 11 months. And now we're here. But I got a takeaway from you, applied it. That builds trust. That gets us here. And that's what starts building the relationship. Same way with the owners. I just asked for a meeting. Some people will say no. Some people will say yes. But if I get a takeaway, I apply it. That builds trust just like it did here. And that builds the relationship. And that's where the opportunity comes. People get stuck too much once you get to the coffee meeting of, well, let's just relate. I love fishing, or I love boating. They try and relate. Relatability gets you to the table on that phone call. As soon as you get to the table, you have to share your goals, because people work with you based on the goals that you share. And what changes for you when you hit those goals is what determines if they're going to buy into your story. And that's where the opportunity is. When you get buy-in, it's not the why. Oh, I want to retire my mom. Well, what changes when that happens? Well, now she gets to live a life that she never dreamed of, because she never thought she'd be able to retire. That's what people should be sharing, not the, oh, I want to be able to do this. What actually changes? And I'm excited to chat with you more after the podcast, because we start building that relationship, see where it goes. But this is how I play the real estate game. Instead of a business owner, it's just some person, guy or gal, that built something epic. And I want to learn, how the heck did you do this? It is that simple. There's no extra steps. It's the reason our biggest rule is don't add steps. Meet with the players, learn how they became a player, repeat it, and you're a player.
That's all you have to do, believe it or not. And a lot of other things besides just real estate. Dude, you're a smart kid. You figured it out, okay? You don't meet a lot of young people that are smart like this.
Appreciate that.
How old are you?
31.
So when you met him, were you like, "Freck, this is a smart little son of a bitch"?
Yes.
Yeah, I would have too. I'd have said, "Hey, damn, dude, this dude's smart." But hey, I'm hoping you guys crush it. The multifamilystrategy.com is where you guys go if you want to follow these guys and or pick their brain, so to speak. Cody D 2020. Is that right?
Oh, I actually changed it. My old Instagram got changed. So it's at Doing Cody Things, because I am, in fact, always Cody doing Cody Things.
At Doing Cody Things. And yours is at Christian. Gotta put my damn readers on.
Christian Osgood. He's got a less.
Christian, just like it sounds, Osgood. OSGOOD. Christian Osgood.
You got it.
And at Cody, at Doing Cody Things. Appreciate you guys coming in and listening to the podcast. Go out, share, subscribe like you do, or share and rate like you always do and you always have. I appreciate that. And until next time, keep it real.